Well, good morning, everyone. David Paul speaking. It's 5 to 9 here in the UK. That's the middle of the night in the US. I've named this video Debt Crisis Rigor Mortis because it seems as if these markets have been going sideways, uh, sitting around a level of 4,110 on the S&P since the start of April. Uh, I'm not particularly worried about the debt crisis. I think that the issues are far, far too big uh, on both sides of the political divide for some form of solution not to be found. What I am worried about, of course, is the drain on the liquidity that will follow. And I note that 600 billion of treasuries will need to be issued to replenish the Treasury General Account in the next few months. And that, folks, in my humble opinion, I'm no economist, will be quantitative tightening on steroids. So it will, in fact, drain the liquidity significantly out of markets, something we need to watch for. So yesterday we had a nice bounce. S&P was up 48 points on the day, and that pushed the VectorVest composite up, and it pushed clearly a green light in the price column of the color guard. So the shortest measure of the trend on VectorVest is up. The underlying trend is in fact down, and we've got a confirmed down in place that's been down since February. VectorVest advocates caution when buying stocks at this time. I think that we're still right in the middle of this range, folks. Although we had a good day yesterday, certainly I wouldn't call it a breakout by any stretch of the imagination. So if we have a look now at the VectorVest composite itself, that's the VectorVest composite, folks, over the last year, and you can see that we've been stuck in this range, and then over the last 6 weeks we've been in this really, really tight range, and I think you can see that we're still within that tight range. The buy-sell ratio, the VectorVest proprietary measure of market breadth, has pushed up a little bit out of the mega oversold area, around 0.25. It's pushed up to about 0.4, which I suppose is going in the right direction, but nevertheless there's an awful lot more companies on sell ratings than there are on buy ratings. This formation and this flat formation, with all the bad news that's been thrown at this market, is to me quite positive, but I tend to be overly optimistic. Those of you that have listened to me will know that. What have I been doing in this environment? Well, I've still been holding on to that position in the QQQs, and it's going darn well. One of the few sectors that is moving, and there's a couple of big stocks within that sector that's driving it up. I think you could have probably done better in one of those stocks that are outperforming the market, but I was happy with the QQQs because everything's in the one place. This is just such a textbook bull flag, 5-wave bull flag, absolutely textbook, right down to these last old highs. And it broke up, and then market moved up, went sideways for a while, and then charted a textbook Wyckoff spring. And out of the Wyckoff spring, away she went, and still going. You know, unfortunately, at the moment, we're pretty stretched here, folks, because if I put on my fib extension, I can see that if I extend the pullback, that yesterday's high was exactly 1.618 of that. So above this level, we start to need to have to wear a hard hat. The measured move is still way above the market, still a little bit to go. So hold it, but I think Titan stops there, and maybe taking a bit of profit. I've got my 2x position on here. Maybe it's time to take one off. I'll think about that during the course of the day. I've also taken a position short of gold, and if you've been listening to me for the last week or two, I felt that gold was moving up from this low, and this pattern tends to be the final act. It's what the Elliotian folk will call a diagonal, or a common technical language, a rising wedge. this tends to happen right before a collapse, and I'm not short from a great level. If I was at the top of my game, I should have shorted it there, but I didn't. Only shorted it below that low as it broke down through this multiple inside pattern. So that's short from 2000, and where are we now? Sorry, the go to webcast software gets in the way. 1973. So it's going the right way. Clearly, huge level here. Down at, again, it's in the way, down at 1959. So expect a bit of turbulence here, but normally we should expect, after a 5-wave advance of this magnitude, 3 to 5 weeks sideways to down. I've also got a position long of the GDX, which has taken a little bit of punishment on the last day or two. This position's made up for that. I rarely hedge positions, but I'm going to try and do my best to hang on to the GDX position because of this huge pattern in gold. You know, this huge pattern in gold that's playing itself out way back for years. In this huge cup and handle pattern that I pointed out on many occasions. But I think there's a little bit of pain to come in gold before that happens. Let's see. The S&P itself, folks, well, the S&P, I promised myself yesterday that I wouldn't trade, and I haven't traded. This is last Friday. And there was an inside. I like inside bars, not because they predict the future that well, but because the risk associated with trading an inside bar is just so low in relation to the potential target. But I didn't. That was very late in the day last Friday. I didn't trade that. I didn't see anything to do on Monday or Tuesday, but I couldn't resist this one yesterday. There's this big, wide-ranging bar, and then we got 1, 2, 3 inside bars, and then it broke, and I closed above this bar, and I bought in there and took 20 points. That's really all I've done intraday this week. So very quiet week intraday for me. Yesterday morning, I was determined not to trade at all until the market broke out of this range. If you have a look at the daily chart, you can see, get rid of all my lines, you can see that we've broken out of this one little range here, but we're still encapsulated in this tight range that goes from 4050 to 4160 odd. And I would like to see it break one way or the other. I think that a positive resolution to the debt crisis will initially cause us to move up, and probably move up very strongly indeed. I think the market expects what I expect, that the stakes are too big on either side for some form of solution not to be found. But I do worry about the liquidity crisis as the Treasury General Account is refunded with that huge amount of money, $600 billion. In the UK market significantly stronger than the American market for once. But as we know to our cost in the UK, it's always best to be taking positions in UK stocks when the UK market is moving up and the American market is moving up. And that's certainly not the case at the moment. But I'm reasonably happy with my UK portfolio. I got stopped out of one stock, plus 500, big deal. But the rest are going. I'm very happy with them, in fact. One little company called Jet2 has just charted a textbook airline company, just charted a textbook Wyckoff spring over the last few days, in fact. So folks, frustrating when markets are in such a tight range as this. Let's sit and wait this out until we get a break one way or the other. Thanks very much indeed. Bye-bye.